Patria Private Equity Trust invests in a diversified portfolio of private equity funds and direct investments in private companies, through co-investments and single-asset secondaries. It partners with around 15 leading private equity managers and provides exposure to over 600 underlying portfolio companies. The fund offers a quarterly dividend, which has grown in value every year since 2010, and the manager charges a flat management fee of 95 basis points with no performance fee on top, which is unlike most private equity investment trusts. The trust's annualized NAV total return of 14% to end March 2025 over the last 10 years was ahead of both the MSCI Europe Small Cap Index and the UK All Share Index, and broadly in line with its close peers. The fund pursues a concentrated, high-conviction strategy of partnering with a small group of top-tier European general partners, with a strong emphasis on sector expertise. This is an important advantage in the increasingly competitive private equity space, and this strategy has proved successful over the long term. Its core partners include names such as Alta, HG, IK, Nordic Capital, PAI, Archimed, Triton, and Vitruvian. The fund has long-term relationships with them, often spanning more than a decade. Patria Private Equity Trust focuses mainly on the European mid-market, which is defined as companies with enterprise values between €100 million and €1 billion. The manager has recently communicated its intention to further increase the portfolio exposure to the lower mid-market, which means companies valued between €100 million and €500 million, which it believes provides the greatest potential to outperform the broader private equity market, especially in the more normalized interest rate environment. The private equity mid-market offers several potential advantages. Firstly, many of the acquired companies have not been owned by private equity managers before, and therefore offer low-hanging fruit in terms of value creation. Secondly, portfolio exits are less dependent on the IPO market, as there is ability to sell into the private equity large cap space, as well as trade buyers. Thirdly, deals are less reliant on funding via syndicated loans, which was muted during the recent market downturn, and also often involve less leverage versus large, mega buyouts. The trust's maturing portfolio provides the potential for good exit opportunities when private equity market activity picks up. Typically, over 50% of its portfolio has been held for 4 years or more, so they are mature for exits. The trust's portfolio is skewed towards sectors with typically lower cyclicality. Firstly, this includes IT companies, mostly profitable B2B businesses, such as Visma, a provider of mission-critical business software to SMEs. Secondly, healthcare companies with little exposure to higher-risk biotech. For example, it is invested in NAMSA, a contract research organization for preclinical and clinical device companies. And finally, consumer staples such as the Spanish food retailer Uvesco. The trust highlights that while the remaining part of its portfolio, consisting of sectors such as industrials, consumer discretionary and financials, is in more cyclical areas, it includes subsectors that offer a combination of good growth opportunities and a valuable product or essential service with a strong digital component. These include environmental B2B services business ACT, provider of funeral services FU NECAP, cyber insurance broker CFC, and payments company Planet. The manager believes that only 9 of the trust's top 100 underlying portfolio companies as of end March 2025 are directly affected by US tariffs. The strong long-term relationships with its top general partners support the fund's deal flow in terms of direct investments, that is co-investments and single-asset secondaries. Direct investments offer greater flexibility in terms of capital deployment, as they are done on a case-by-case basis, leading to higher capital efficiency and easier balance sheet management. Moreover, unlike fund positions, GPs normally often do not charge fees on direct investments, translating into a one-layer fee structure and therefore the potential for higher returns than funds. The investment manager highlighted that he expects more exits from the direct portfolio in the next 12 to 24 months. If you would like to learn more about Patria Private Equity Trust, please visit Edison Group website.